your Pimco, I want to get the bond call. I mean, like, what do you do? JP Morgan says you still want to short the long end because it's run too far. Like, what do you think?
Well, when we look at Treasury yields, they're probably in the zone of where they're likely to be. We'd expect interest rates to be largely range-bound this year and credit spreads to be largely range-bound. Those are the two major components of returns. This year is likely to be a so-called coupon clipping year for the bond market. We wouldn't expect the virus issue or other issues to come up that are unknown so far, but who knows, that would cause interest rates to fall meaningfully. In other words, Treasury yields in the current zone, call it 150-ish, and I'm going to go through a component there in a second, probably about right. They can't move downward a lot without a Federal Reserve interest rate cut. The Federal Reserve will meet this week. There'll be no signal for future rate cuts we would expect. We're not expecting a rate cut this year. It does lean toward the likelihood of one. So rates won't move much. Credit spreads, for them to tighten much more, relative yields to tighten, shrink relative to Treasuries, would require more confidence and optimism, which doesn't exist.
We're gonna get, right.
And for a sharp widening of credit spreads, a big move in yields above Treasuries, it would take a big doom and gloom period. And we're not expecting that because the global economy seems to be faring well. So we would say just stay with the program, so to speak. Don't expect much to change. One final point is 2-year Treasury notes trading under where the Federal Reserve's policy rate is. It's not generally a sustainable condition, but it's only marginally below, which is basically the market saying, well, something bad could happen, but probably won't.